when a major corporation decides to get out of line of business or maybe sell off a factory, the story they tell investors has to change instantly.
It has to. This isn't just some casual announcement.
No, the second that decision is made, the rules of financial reporting they pivot completely.
And that pivot is essential because investors need to know what the company they're putting their money into will look like going forward. What's the core business going to be?
So our mission today is a deep dive into the standard that controls this whole transition, IFRS 5. We're talking about the non-negotiable rules for classifying those long-term assets as held for sale or HFS, and crucially how that's different from a discontinued operation. We want to get past the checklist and really understand the why behind all these meticulous rules.
Exactly. At its heart, IFRS 5 is really just asking one simple question. Is management going to get the value of this asset back by using it or by selling it? If the answer is sale, then boom, the standard kicks in. The focus immediately shifts from, say, depreciation and use to market value and how quickly you can turn it into cash.
All right, let's unpack that, starting with what sounds like the toughest part.
Right.
Actually classifying an asset as held for sale. This isn't just about a CEO saying they want to sell something, is it?
Oh, not even close. The criteria are really strict, and that's by design. It's to stop management from, just tidying up their balance sheet by pretending unproductive assets are about to be sold.
A kind of commitment device.
That's a perfect way to put it. The first big hurdle is that the asset must be available for immediate sale in its present condition. And that one sentence, well, it carries a surprising amount of regulatory weight.
So what does present condition really mean in practice? I mean, if you're selling a giant manufacturing plant, there's always something that needs finishing up.
Right. Well, think of it like selling a house. You can't tell a buyer it's ready to go if you've still got a tenant with 6 months on their lease, can you?
No, of course not.
Or if there's a lien on the property, it's the same idea here. No major repairs can be pending. Any backlog of orders has to be cleared. And critically, it can't be leased out to someone else. Nothing can be obstructing that sale.
So it all comes down to transferability. The buyer has to be able to take over right now, basically.
Pretty much, subject only to, the usual legal closing process.
Okay, that covers the physical side. What about the formalities? Can management just make this call on their own?
Absolutely not. To prove the commitment is real, you need approval from the top. Usually that means shareholders' approval is a must.
Usually.
Well, or at least the governing body that can approve it if shareholder sign-off is just a formality. Plus, you'll need regulatory approval if it's, say, a regulated asset. The whole point is to make sure the intent is legally and procedurally solid.
Got it. So that's availability. Now, what about that second pillar? The sale must be highly probable. How do you prove something like that? It sounds a bit subjective.
It does, but the standard gives us clear evidence to look for. This is where we measure the actual execution. First, management has to be explicitly committed to the plan. It can't just be an idea they're exploring.
It has to be the plan.
The primary goal, yes. Second, they have to have calculated the fair value. I mean, if you don't even know what you think you can get for it, how serious can the plan really be?
And I imagine you have to actually be, selling it, not just thinking about selling it.
Precisely. The asset has to be actively marketed at its fair value. And an active, documented program must be underway to find a buyer. This isn't passive waiting. It's an aggressive search.
Okay, now here's where it gets really interesting for me, the time pressure. The sale has to be highly likely to be completed within 12 months of that HFS classification. And there's a NOU turn policy.
Yes. That 12-month window is the ultimate test of management's conviction. It forces their hand.
But what happens if the 12 months pass and no sale? It happens.
It does. And the standard has a really important exception test for that. It all depends on why the delay happened.
Okay, explain that.
If the delay is due to uncontrollable factors, things totally outside of management's control, like a sudden market crash that freezes all deals or an unexpected regulatory holdup.
So an act of God, almost.
Sort of, yeah. In that case, the asset can continue with HFS accounting as long as management is still actively trying to sell it. It's like a temporary pause button.
But what if it's their own fault? Like they're just being too greedy with the asking price and keep rejecting reasonable offers?
Then the HFS status is gone immediately. If the delay is due to controllable factors, things like bad marketing, being unrealistic on price, a simple lack of commitment, the asset has to revert right back to being a standard, non-current asset.
And it goes back to being depreciated and everything.
Everything. And that reversion, it sends a very clear signal to the market that the sale plan failed.
And this has a huge impact on the balance sheet. A normal NCA is on the books at cost minus depreciation. How does an HFS asset get recorded?
The rules force a very conservative approach. The asset is immediately recorded at the lower of two numbers. Its current carrying value, the book value, or its fair value, minus the cost to sell.
So the book value is high, but what you'd get from the sale after paying the lawyers and brokers is lower. You have to recognize that loss right away.
Immediately. It forces impairment recognition. It's a cleanup measure. It ensures the balance sheet reflects economic reality, not historical cost.
What's really crucial here is the focus. HFS is a balance sheet standard, right? It's about an individual asset or group of assets.
Exactly. It's focused on the statement of financial position.
But now I need to shift gears to something that impacts the whole performance picture. Discontinued operations.
Yes. If HFS is about cleaning up the asset side of the balance sheet, discontinued operations is all about cleaning up the income statement. We're not just selling a machine anymore. We're talking about severing an entire business line.
And for that to happen, the operation has to be what the standard calls a component of entity. That sounds like some heavy technical jargon. What does it boil down to?
It just means the operation has to have its own clear financial boundaries. Its revenues, its costs, and especially its cash flows have to be separately identifiable from the rest of the business. If you can't draw a neat line around its financial performance, it doesn't qualify.
So what kind of components are we talking about?
It can be defined in a few ways. Geographically, for example, a company might sell off its entire European division.
Okay.
Or it could be product-wise. They might ditch their entire line of consumer electronics. A really clean example is a subsidiary that was bought only for the purpose of reselling it. From day one, that's a discontinued operation.
Because the intent was never to integrate it.
Exactly. The intent was always to flip it.
Now, let's talk about that interesting case of abandoned assets. This really helps clarify the difference. What if a company just shuts a factory down and has no plan to sell it, just lets it sit there?
This is a great question. Because there's no intention to sell, it absolutely cannot be HFS.
Right. HFS requires a sale.
But if that abandoned factory was a component of entity, if its historical results were separately identifiable, then its final results, all the losses and write-downs, will still be reported as a discontinued operation on the income statement.
Ah, so the trigger for discontinued ops is just stopping the operation, not necessarily selling it. While the trigger for HFS is the explicit plan to sell. That's a critical distinction.
That's it, precisely. One cleans up the balance sheet, the other cleans up the performance story.
Okay, let's look at the statements themselves. As an investor, what changes do I see on the income statement when there's a discontinued operation?
The standard is incredibly specific here. It demands surgical precision. The income statement has to first show the entire profit calculation for the continuing operations. Revenue, expenses, tax, all the way down to a subtotal for the business that's left.
And then comes the separation.
Yes. Right below that, you get a single, separate line item, profit or loss for the period from discontinued operations. Then you get the grand total. That single line is so powerful for analysts because it instantly strips out the noise.
But the detail has to be somewhere, right? People need to know what's in that number.
Oh, absolutely. The full breakdown, the revenue, the expenses, any gain or loss on the final sale, all of that has to be disclosed in the notes to the financial statements.
And what about the statement of cash flow?
Same principle,
Yeah.
Separation. The cash flows from the discontinued operating, investing, and financing have to be reported separately. You, as the investor, need to see if that unit was burning cash or generating it. Again, either on the face of the statement or in the notes.
Okay, now for what I think is the most powerful part for investors, the comparative reporting rules. If a business unit is discontinued this year, what does the company have to do with last year's numbers?
This is the single biggest difference, and it's huge. If an operation is classified as discontinued in the current year, the company is required to restate last year's comparatives as if it were already gone.
Wait, they have to physically redo last year's P&L for the annual report?
They do. They have to go back and pull that discontinued segment out of last year's numbers and show it on that single line. It forces a true apples-to-apples comparison.
That is massive.
Yeah.
So as an analyst, I can see exactly what the core business's growth looked like last year without the distortion of the part they just got rid of.
That's exactly it. It prevents a company from looking artificially good. It gives you a clean, restated baseline to work from. You can track the real trends in the continuing business.
And just to be crystal clear, there's no such rule for an asset held for sale.
That's correct. If an asset is classified as HFS this year, there's no requirement to go back and reclassify it as HFS in last year's balance sheet. HFS is seen as a temporary status. Discontinued ops is a permanent strategic shift, and that requires rewriting history, so to speak.
When you put it like that, the intent of IFRS 5 becomes so clear. It forces a company to tell you, are we just cleaning up the balance sheet, or are we fundamentally redefining our business?
And that clarity is invaluable. Okay. That restatement rule gives the entire investment community a clean, historical model of the new core company. It just dramatically improves the quality of any analysis you try to do.
It provides that essential clarity right when you need it most during a major transition. Now, for you, the listener, to think about this week, we said that if a company fails that 12-month sale test because of controllable factors, they changed their mind, or they were stubborn on price, they have to reverse the HFS classification. So if you see a company that is constantly doing this, classifying and then declassifying large assets quarter after quarter, what signal does that send to you about management's ability to execute? Or maybe their basic understanding of what their own assets are actually worth. That's a fascinating indicator to mull over until our next deep dive.